Welcome to American Building. I'm your host, Atif Kader. Join me as we explore the skylines and strip malls, the crosswalks and rail crossings, the balconies, the buildings, and the boroughs shaping the next generation of real estate. Let's build common ground. Today's guest is Joe Furey, CEO of Michael Graves Architecture and Design. Joe began his career in finance and technology, working in securities and as a CFO for a business unit of a Fortune 500 IT company. That was before joining Michael Graves as the CFO in 2008 and acquiring the firm in 2018. He transformed the practice into a full-service design and technology firm. Based in Princeton, Michael Graves now operates across the U.S. and internationally with roughly 165 staff across 10 offices. In this special episode of American Building, we'll talk about the firm's evolution, refocusing the business strategy, growing core services, launching technology consulting, and scaling through acquisitions. So thank you so much for being here with us, Joe.
Thanks for having me on and this episode. It's a lot going on over the last couple of years, and it's fun to talk about. We've had some great success as a team. You mentioned 165 people. Every one of them contributes. So we're excited about where we are, where we've come from, and really more excited about where we're going in the future.
Amazing, and that's going to be the whole theme of this special episode. Let's dive right in. So, starting from the beginning, you're not an architect. You're actually an accountant by training. So, tell us, like in plain English, what you learned in the accounting process that has really set the foundation for the role that you're playing at the firm now.
Well, so interestingly, I was actually a political science undergrad with some crazy idea of becoming an attorney. Was fortunate enough to get a job at a school in accounting at Yankee Stadium, and was my first boss, who happens to now be our CFO, Mark Pizzariello, taught me what I needed to know. But I also needed to go back to school to take all the accounting classes that I never took as a political science major, and then go down the whole path to CPA exam and so on and so forth. So that background is unique. I think I always draw on that undergrad degree in political science for a number of reasons, a number of things.
Maybe business development, chatting before a meeting, all that stuff. So
yeah, but back to accounting and that I always. There's a couple types of accountants, and I always tried to be the one. So, like I would say throughout my whole career, we will, as an accounting and finance group in a company, we want to spend 80% of our time looking forward and 20% of our time looking backwards. So, what processes can you put in place to sort of predict the future? So when you're closing the books for the month, there's not surprises, right? If we do a great job of planning and forecasting, then we shouldn't have a lot of surprises. So closing the books and getting the numbers locked down for the prior month should take 20% of our time. And that enables us and frees us up to spend most of our time looking forward, and as finance people, really partnering with the business lines to support them and give them the real help they need to do their jobs to run the business. So, and I take it back to football. You if you're losing, if you lose the game, right, and your accounting person says, "Well, look at the scoreboard. You lost 56-0." Well, what the hell were you thinking, right? Well, a good coach is going to go in at halftime when you're down, 28-0, and start making adjustments, right, and come back and win the game, 42-35. That's what a finance person should be doing midstream every day. Hey, we have an assumption in our plan. We're now going off track. Let's understand why we're going off track, and more importantly, what can we do to get back on track in a timely manner, right? So, and that's what I think separates the great finance people from the day-to-day, type of people. And it enabled me to get outside of finance into, running a business.
So it sounds like the personality traits and the skills that you focused on or you highlighted were sure being thorough and being accurate, which are probably traits that people will associate with being an accountant, but more importantly, being creative, being a big picture thinker, being a problem identifier, and a problem solver, and then using all that information to create that plan and strategy for what to do next. Does that sound right?
Absolutely. Yep.
Amazing.
Identifier and solver. Those are two things. It's easier to identify the problem, particularly if it's sort of after the fact. It's different to say I found it early, and oh, by the way, here's a solution, right?
So one of the things we'll dive into as we continue on is your transition to ownership in the firm. And I think um, both the problem identification and the problem solution are both really important skills. And I'd love to hear that theme come up again. So you worked in securities. And for some of our listeners, that might mean Jordan Belfort and Leonardo DiCaprio and The Wolf of Wall Street. So tell us what you did there and what you learned in that part of your career.
So I went there as, and the titles will escape me. Maybe it was a accounting manager and then assistant controller. I was there for 3-4 years. It was a broker dealer, and I was in basically general accounting, and so it was everything from soup to nuts accounting. And then I tried to do some things that lent itself to the trade, really the trading floor guys were their profitability, their P&L. Taking a deeper look to see where we were making money, where we weren't, and again, what can we do to change the direction there. But at that spot, my first job, we were operational finance and accounting, which was really good experience. And then there was corporate that did a lot of the nuts and bolts, other types of accounting. At the broker dealer, Tradition North America, Tradition Government Securities were the companies. I was able to see literally end to end on the accounting side of things and get involved in virtually every aspect of accounting from start to finish.
So that added to the knowledge that you gained, and then you took your first leadership role at a Fortune 500 company. It's called CSC, and it was a technology services outsourcing company that operated in 70 countries at its peak, and it was bought by Hewlett Packard, if I understand correctly. Is that right?
It's called DXC now.
DXC.
Yep. But actually, I had a stop in between there, which was at Solomon Smith Barney, and
Okay.
that was a unique role, and that's what. So I was pretty good with I'm dating myself now. You probably don't even know what this is, but Lotus, which was like then Excel came out through Microsoft, but
So
I was a
I'm a
dude.
budding F1 fan. So Lotus to me means a racing car, but I
Yeah.
presume you're talking about a software.
Yeah, I was like the precursor to Excel, I guess. It's gone now, I think. So
Excel is on its way out as well too. So
I hope not. Well, I don't even use it that much more. So so I sort of fancied myself this sort of IT oriented accountant because I was literally writing macros and scripts and all these things, which was pretty cool. And so I had a 2-3 year stop at Solomon, which was leading up to Y2K, and the role was interesting because it was like in the IT department, but mostly IT people and some project managers, but they needed someone with an accounting finance background that could talk to the trading floor people in that language and then be able to work with the IT people, right, and connect those dots. And so that was 2-3 years there, and then of course then CSC after that.
So, a big portion of that CSC experience, and the nature of the company, is understanding technology and outsourcing that work. And I think outsourcing is just one route of the proper asset allocation or resource allocation, rather. And talk to me about some of those skills or experience that you had there that colored your thought process as you transition later to Michael Graves.
Well, we talked in the beginning about the key role of a finance person
Totally.
being spend 80% of their time looking forward to help drive the business. And that is probably really where I honed that skill and really double down on that. Uh, so that you can imagine, contracts CSC had with its clients, 150 million a year, software, 500 million a year. And it was infrastructure outsourcing and applications outsourcing, which was more people than stuff, whereas the infrastructure was more stuff and less people.
Mm-hmm.
And the bottom line was that the contract was set with a plan, an IT plan, a transformation plan, and it was a matter of understanding the contract, but more importantly, the bid model, which was an enormous series of Excel files that were essentially the assumptions for, not your annual budget or your monthly numbers, but this was a 5, 7, 10-year set of budget assumptions that really had to get blown down to a more detailed level and then operationalized. And so, for example, a plan might be that on day one of year two of a deal, a full impact of a transformation in the first year is going to take place. So in order to get that full impact that year, that means you have to have the entire plan executed by the last day of the first year, right? And so this is like going from annual assumptions down into details. So that might, force a little bit of adjustment to the plan. But if the team wasn't executing on the plan in year one, then we were in for an absolute financial disaster beginning in year two. And I took the time to understand the deals. What are we selling? Right? That was the question. What did we sell to this client? We need to understand that and then execute on it. And it wasn't like I enjoyed what I did, but part of what I did there I didn't like, which was a big component of that business was outsourcing jobs offshore, U.S. jobs offshore. And, I had to do my job, but that might have been the biggest reason I wanted to seek something else. I just didn't enjoy that part of our business.
I feel like there is a Netflix show called Outsourced, which is, I think, have you seen that show?
No.
Okay, I will include it in the show notes. It's basically a vision of you at that stage of your life, like literally. That's exactly what it is.
Beautiful.
It's a great one season Netflix show, one and done. Now, okay, let's shift gears. I want to talk about Michael Graves, the person. So Michael Graves was a very well-known architect, whether fairly, unfairly, star architect, he's been known as. And he is the father of postmodernism and some could say new urbanism as well. So you're a CPA, as we just discovered, and you worked in IT transformation and outsourcing. So I don't presume that the two of you had tons of like social circles in common or work kind of circles. So how did you guys actually meet?
Well, I had reached out to a recruiter and said, find me and by the way, my last job, I was traveling all over the place. My kids were young. So I said, find me a CFO job for a privately held company in Princeton. Mm-hmm. And when the guy finished laughing, he said to me, how many of those do you think actually exist? And I said, I don't know, just find it and I'll get back to work. And I want to say less than a month, maybe 2-3 weeks later, he called me and asked me if I knew who Michael Graves was. And being honest, I said, sounds familiar, but I don't think so. And then I quickly did, one quick search and figured it out. And then I recognized buildings in and around Princeton. Oh, that's a Michael Graves building. Oh, that Target. Yeah, I get it. Yeah. So I pieced it together quickly. So then I came in for interviews. And let's see, I think I came in 3 Wednesdays or maybe in a row, and Michael was the last day. I met him and Sharon Patrick was a consultant. Sharon was Martha Stewart's COO, CEO, I think, for a while. And Sharon was consulting for Michael and leading the process for the search for this role. So it was interesting meeting her as well.
So there's 3 meetings in a row, and what stuck out for you about Michael's personality, demeanor, approach to his business?
Well, so Starchitect, I figured that out fast, like how famous this guy was. Now, Michael, when I met him, this was 2008. It might have been 2007, before the holidays that I was originally coming in. But Michael was already paralyzed a few years. He was back in the office. So, and I've seen videos of Michael pre-paralysis where he was, you could see the difference in him. He was a little slowed down, obviously.
What was the circumstances of the paralysis?
Um, as I understand it, and without getting too technical and medical, he had like a sinus infection that went uh, crazy and started like attacking his spinal cord, and was in a ton of pain. Went to the hospital, and it was life threatening there for a while. Number of surgeries,
Mm-hmm.
yeah. But he had his mind, he had his hands, so he was able to still draw, and he did a lot of painting, which he loved to do, and still participated on the architecture side and the products side. When I joined the company.
Amazing. And I think he used that unfortunate circumstance to actually become an advocate for disability and alternative methods within design to make products and buildings more accessible. Is that correct?
Yeah. So on the consumer product side, number of products and the team in that business, Donald, Rob, and Ben are still, they're doing a number of different products, but they still have a focus on accessibility types of products. And, Michael, you talk about Starchitect again, just think about this. Hey, he was in the White House with presidents from Reagan right up to Obama. I'm not sure that he actually was there with him, but President Obama appointed Michael to the Access Board,
Yes.
to focus on accessibility. So, for to be in those circles, right? I mean that's the Starchitect, right? And he did great work, important work. And
So,
postmodern had its time, was very important in its time. So
like the Portland building, the Humana building, those are the classic foundational buildings that he worked on that created his name.
yeah.
So you come on as CFO, and because this is a special episode, we're going to focus a little bit less on the buildings, a little bit more about the nitty-gritty, the behind-the-scenes processes. So how was the firm exactly doing at that point, and what were the opportunities that were in the hopper?
So we were actually cranking pretty well. So there were a number of projects going on in and around 2006. What's now the St. Regis, it was called the Nile Corniche. It wasn't branded yet, but that project, which is the St. Regis in Cairo, Egypt, and Resorts World in Singapore, Sentosa. Those were two projects that were kicking off in 2006, and those were humming when I joined. There was project at Princeton University, project at Texas A&M, Temple University. I mean, there were a number of projects going on in the office, and those years, the year before, that year, and maybe even the year after, like that was like peak revenue for Michael Graves in the history of the company. But what was leading up, and it all led to our strategic plan, and I've got a couple slides on this too. There was this sort of confluence of events that had happened that were almost catastrophic. So one, with Michael being the Starchitect, the team, when he got paralyzed, they did a good job of carrying forward the business, but it was like the next level down. They were not wired to be seller doers. Like, we do acquisitions, and Ravi Walden starts his firm, Walden Studio Architects, and he doesn't have the benefit of a Michael Graves brand, right? He's got to go find work, sell it, convince somebody to hire him, and then go deliver good work to get more work. Not that we didn't do that. Of course we did. But when you have the brand, the phone rings more, right? So it's
Totally.
a different thing for business development. So that was a big question. What happens, right? And it was happening, actually. Michael was getting
in real time.
paralyzed. The postmodern movement, like that style of architecture, was, we weren't doing that, right? And there was some perception of people like, well, are you gonna, you want to design my hotel, or are you going to put a dolphin and swan on it? Well, it's kind of a silly question. Maybe it's a way of saying, we're just not going to hire you because we don't know, you guys, and we have other people. So getting over that hurdle was part of the strategy.
Sure.
Michael was getting older. I said that. And then, really the blessing and curse for us, I want to, we do work all over the world. You mentioned it in the intro. We always have. And when the mortgage crisis happened, that took a huge impact to us with work in the US. And one of those years, like the year or two after that really hit, we had one year that was like 95% of our revenue or international projects. So you can imagine what would have happened. We'd be done if we were not diversified to be doing work around the globe. Mm-hmm. And that got us through that. And then that really kicked off the beginnings of our strategic planning. And I just looked at this as a pragmatic business person. We have an amazing brand. The people that work here are amazingly talented. Mm-hmm. We have a great story, a great history. We got to repackage the brand a little bit, which we've done. We had done a couple times. What we have now, I really love. And then the big punchline there was we were a mile wide and an inch deep. What do I mean by that? Well, one of Michael's lines was, people would ask him, what's your favorite project? The next one, right? So and that could be like going from a hotel to a museum to a campus building, at a university. And so we designed every possible type of building, but we weren't deep in any one sector. And a lot of times you need to show 5 in the last 3 years of similar types of projects and things like that.
So on a funny side note, H.H. Richardson, who's the one of the most famous architects of the 1800s, he did the Trinity Church in downtown Boston. He said when he was getting started, he was happy to design anything from a chicken coop to a cathedral. So there it is, mile wide.
Yeah. And so, that to me, the light bulb went off. It was pretty obvious, right? We needed to grow and build this portfolio through an acquisition strategy, which was maybe a crazy thought in architecture even 10 years ago. It was happening on the engineering side, less so on architecture. Mm-hmm. It's not really heating up, in our space on the architecture interior design side. So
amazing. So we'll be definitely focusing on that. And specifically, you bought the firm in 2018. So how does that work exactly in terms of a process and structure of going from employee to owner?
Yeah, so I bought in with equity. We still had the original partners. That were left were still equity partners. I didn't buy 100% of it. And then, in going forward with future deals, we don't buy 100% of a firm. We're somewhere between 51 and 60% of the equity we acquire, because this is, it's a challenging business. I often say we're double complex in the sense that we're a people-based business and we're a projects-based business. So, projects could be a month long, they could be 3 months long, they could be 2 years long or more. So when you combine the complexities of a people-based business and a project-based business, you really got to understand the dynamics. Mm-hmm. So to buy a company, one takes on risk. Our thinking on this is we're going to buy a percentage of the company because we want to manage that risk. But more importantly, for you, the owner of your architecture firm, we want to bring you in to mitigate our risk, but we also want to bring you in so that we can help you transition your firm, create a legacy for yourself, your firm, your life's work, for your employees, but also help you monetize your business in a way that if you just sold it outright 100% to someone, you'd make significantly less than what you'd be able to make with us, with our structure, and bringing rolling equity and participating in the growth going forward.
Got it. So the way that you acquired Michael Graves is a reflection of the way that you are bringing on new firms to join the Michael Graves family. Is that correct?
A similar philosophy so when I was talking to the then partners of Michael Graves, obviously I'm not an architect. I can't design buildings, and I might argue I can do a slightly better job than you guys are running a business. So let me focus on the business, you focus on design, and we'll be, happily ever after.
So, In terms of the acquisition of the firm itself, when you became the owner, um, acquisitions don't go smoothly, and a lot of the issues that come to bear happen after perhaps an acquisition. So, talking about any of the problems that you identified and how you were able to go through and solve them, perhaps leaning on the skills and the experiences that you had earlier in your career.
Yeah. So coming back to Michael Graves after Michael's death and buying in, um, like I said earlier, a great brand, talented people, but we had to do some work on the business. And I feel like I had a unique position in that I had worked here for 10 years prior. So the partners knew me and trusted me to run the business, treat them fairly, and, you know, get them. It took some time to get them to buy into the thought process of acquisition. I mean, being a world renowned firm, it's probably a fair question. If we acquire a less known, more local or regional firm, how does that fit? And I think, Karen Nichols is one who's been here for a long time. Though she's the longest tenured employee, she's everything to the companies, that basically performed in every kind of role. But I have her as strategic marketing. And what do I mean by that? So Karen, pre acquisitions, remember a mile wide and an inch deep. Karen is brilliant, but always managed to take, like, cobble together nuggets from different projects to get us to actually qualify or get us really close to qualify for a project. Whereas if you read it black and white, like, we don't have all the requisite projects to check that box. And I think she would say that initially she was skeptical of, what is it going to be like when we do these acquisitions. But now she has more ammunition to piece together the strategy and the projects that are required to check the boxes. Now that we have this, 165 people and all these projects, and even to the point where it's like we know there are more projects out there that we don't have on the website or in project sheets, and architects do that, right? They just don't keep that up, and that's where we've made some investments in marketing to get in front of that. So I think that was like the biggest, unknown or hurdle to get over. Is this going to work? How is this going to work? Because the academic type, I could picture some people whose names I'm not going to mention questioning, why would Michael Graves be doing this? And I look at it like, number one, we're healthy as a firm. We're doing more work around the country, around the world. We've created value in our company for all of our shareholders, the existing ones and those who join, and we're doing great work, and we're. Yeah. So what's wrong with that? And there's certain projects, like you said, the chicken coop, like,
Uh-huh.
there's certain projects we would do that maybe they just don't go on the website. You do a project for someone, if it makes money, it's what's wrong with that?
So, I think the core of what you're saying as those two challenges that come to play after the acquisition of the firm and you becoming the leader is that first word, I think, in summarizing it, is trust. And Pete Buttigieg had a great book that he released in 2020, kind of summarizing the state of our country in a political sense in the word trust. But I think that has so much of relevance within a business world, especially with this large leadership and structural change that you're talking about. And the other one that you really leaned in on in that description of the challenges was marketing and business development. And a lot of that is about the narrative that you sell and that the ammo that you have to tell a convincing narrative. So I want to then focus in on another question. Okay, so you take over the firm, and one of the key aspects of the business plan, or actually, let me take a step back. Lay out the bullet points in very clear, plain English after you've done your first 90 days as the CEO, what your business plan was in order for this firm to go to the next level that you wanted to go to.
So at that point, it was marketing, more sophisticated or strategic, to get the reach broader, then develop relationships with people, get them to know you, like you, and trust you to hire you to do the work. While we had the brand, we did not have a lot of those deep connections, right? And with that, I mean, it's just take care of those two things. If you take care of those two things, revenue comes in, then the rest is managing a business, which is important and it's hard. But, I always say, like, getting revenue is the hardest part of any business. Most people can manage a P&L, if you're in business, right? Some better than others, but getting the work is the hardest part. So that big focus was around getting the work. We also focused on the strategic plan, which is where we are now, but getting that off the ground. Who was going to finance us to do those first acquisitions? And then, of course, we got interrupted with COVID. So we actually, so bullet point number 1 was sort of fix organic growth. Bullet point number 2, strategic acquisitive growth, and figure out how we're going to get that bullet point number 2 going. So we're focusing on number 1, which is of the now, was important. And, we win a project, we're doing, and then COVID. And I think it was 3 or 4 projects within a month that were awarded, negotiated. There's at least 4 that are on the top of my head that never came back, by the way. And then, when COVID started, but then what happened was this gets back to the brand. We get a email from Saudi Arabia, from NEOM. So one of the giga projects going on in Saudi, asking if we would be interested in participating in a competition. And I said, well, we don't like competing for free, like doing work for free. And the gentleman was like, no, well, we pay good fees for the competition. And I listened to him, and now we've done a number of projects and are still continuing to work on a couple of very, very big projects in NEOM right now. So is it strategy, or is it luck, or a combination of both, right? That that came in. And then, of course, things settled down, and the organic work we were doing, kept going. A lot of that is, it's culture too. I mean, that's another thing, that, I may take a step back. And you talked about, when I came back here, some of the things, and I don't want to gloss over this. We had done some surveys with all the employees of, like, what do we do well? What can we do better? What do you think our core values are? What do you think our core values should be? And the interesting thing that we did there was we would not let any equity shareholders participate in those surveys. It was all the staff that were not equity. And, and that went a long way to some other initiatives. So what do we do well? What do we need to do better? Set up about 4 or 5 different initiatives, technology being one of them, of initiatives that we were going to focus on and invest in to make the company better. All part of that organic startup.
So the key piece that you started on with, it's that organic growth, and then the growth through acquisition. So let's focus on that first one. And specifically, you mentioned earlier the a product element of Michael Gray's design portfolio. And that was absolutely a revenue generating portion of your business, and that has subsequently been spun out. Or is that the correct term to use?
Well, I would, way back, it was all part of the architecture firm. It was spun out as a separate company long before I joined Michael Graves, 2000 through 2003, something like that. And then during most of my time, or during my time when Michael was still alive, we had common ownership between architecture and products. And then post Michael passing away, for focus, the 3 got Ben Whitner, Rob Van Vart, and Donald Strum, who collectively have close to 100 years with Michael Graves. They worked the deal out with the other shareholders, and now we have separate ownership of the 2 companies, but we still are under the Michael Graves brand. So I refer to that as saying we used to be brothers and sisters, now we're cousins. It's the way I
got it.
that.
So so that was something that predated the your ownership of the firm. So your background is in information technology. So perhaps I shouldn't be surprised that you have added a new service to the core architecture and interior services. That is technology consulting. So tell us what exactly you're doing for internally, as perhaps within the technology practice, but importantly, how you're driving revenue for the business through that service.
Okay. So two things. One, back to trust and those surveys, technology.
Mhm.
Uh, we needed more technology, and the younger people who I had to trust came to me and said we should make this investment and that investment, and I had to believe in them that that was going to pay off. You can't really pin it to an ROI, but I knew we needed to up our game in technology across the board, and separately, and more to your point, I think is one of the acquisitions we have done was with Parallax. We were a client of theirs. They were hired by us to help, and this is what they do: help architecture, engineering, and some contractors really use Revit the right way. If I'm going to just say it simply, so they do training, they do licensed content, models, libraries, etc., and they will also help with staff augmentation on projects, particularly when there's a problem with the Revit model. And Aaron Mahler is the president of Parallax,
Mhm.
my partner, and he is an industry expert. And so, what I believe in our industry is the pivot from AutoCAD to Revit is a hard transition, and I believe in the industry right now, as of today, that firms and people are not really using Revit to its maximum capability. And so, doing that deal with Aaron and with Parallax do two things for us. One, it helps us accelerate. We want to be out in front of the industry to be on the right side of the curve of downward pricing pressure. And two, as we're executing our acquisition strategy, he's the integrator for us with each firm that comes in terms of, and he's going around. I think he's hit 4 offices already with training inside of Michael Graves, and he does training for other clients as well. So
Great.
that
And that,
was if you want one word on why, integrator.
so he's an integrator, so that allows your customers from that service to be able to unlock more value, to be able to increase their margins by utilizing their staff resources more effectively. Does that sound right?
Absolutely. And I look at it internally as well.
Okay.
I don't want to be a hire and fire firm. And so, and go back to everything goes back to our strategic plan, a mile wide and an inch deep.
Mhm.
So if you come join us, Octave, and all you've ever done was multifamily work, but um, we've got commonality across the platform with Revit and everything. So you could pivot from a multifamily project to a government project because the learning curve of Revit and how we do things internally has been mitigated for you. Then if your sector slows down due to high interest rates, right, we can have you then go work on other projects within micrograves so we don't have to be forced to do layoffs, which, people-based, project-based businesses, right? That's the thing that you have to deal with when, in our industry, in our space.
That makes sense because you're allocating one resource with one opportunity. Okay, so I want to dive into one of the key pieces of the business transformation that we've been talking to, which is acquiring business, so growth through acquisition. So, walk us through your acquisition playbook in terms of things like sourcing opportunities, integrating opportunities that you decide to pursue, and then measuring success after acquisition. I'm sure there's multiple steps in between all of that.
Sure. So sourcing, initially, one or two of the advisors or business brokers. Now we we've worked with maybe 4, 5, 6 of them. That's one area. Me going to conferences, meeting some people's another. What's also happened is uh, now that we've done 8 or so, we get inbound calls from firms themselves, or from introductions from some of the firms we've already acquired. And one in particular, Jose Carballo, we were actually working with him on a couple of projects pre-deal, and I said to him, "What's your succession plan? What are you going to do?" And he really didn't have one. I said, "Well, let's talk. Let me help you." And so that's one. So there's a number of ways, and it's really it's a deep dive into this to get really the right answer. And it's unfortunate when sometimes there's advisors that are maybe they're prioritizing certain components of the deal that are not in the long-term best interest of that owner. And it's my job to try to cut through all that and make the case. And sometimes I'm successful and sometimes I'm not because of that communication gap. So a number of different source opportunities. I don't particularly like cold calling. It doesn't feel right. I don't like it, so I avoid that. So then you talked about integration as another topic. The diligence. Before I get to integration, the diligence. Of course, you have your normal financial due diligence, etc. But I mentioned earlier that the people part of the diligence is the most critical. We're going to become partners. Like we don't acquire you and send you off to retirement. We don't acquire you and sort of push you down 3 levels in the organization. We do an acquisition of a firm, and the leaders of that firm remain leaders of their business unit and become leaders in the bigger company and partners with everybody else that are partners in the company. And that's really what we're building. So that diligence of do you like me? Do we like you? Does everybody, can you get along? Can you work together when something goes wrong? Because it absolutely will. Something will go wrong at some point. And we got to be positioned. We have a plan to mitigate, that kind of risk. But most importantly, can we roll up our sleeves together and fix the problem?
And that's the word trust that we talked about earlier.
Yeah, exactly. And then, integration is absolutely critical to this thing. So if we go off and we acquire 25 firms, the sum of all of the valuation of those firms will be diminished if we don't integrate. If we integrate properly, the sum of those valuations is going to go up, right? If we do things the right way. And so our integration plan, we have a roadmap, a checklist, whatever you want to call it. And, usually right after signing and sometimes just before signing the deal, if we're confident it's there, we begin that. It's a weekly call with, 5 or 6 key players within Michael Graves at the time, and then 1, 2, 3, however many on the acquired side. And we rip through these, 85, 90 different tasks, and we budget a whole year of time to go through that integration. And most of the items are done now. We're getting them done within 6 months or less. At times we've had 3 or 4 integrations going on simultaneously, and our team here, led by Sean Camo, our COO, Justine Bird, HR, Mark, who I mentioned earlier, and others, do a really good job of just managing through that process. And it seems easy. It's like, change this, do this, but like it just takes focus and repeat, and a lot of times, and it's a lot of people I've talked to where acquisitions can go wrong. And I think that this whole area of integration, it could be different components of integration, but this is the area where something goes really sideways because they either don't have a plan, or they have a plan and maybe don't execute it consistently, or maybe they just miss the key components. I've heard stories of, somebody does an acquisition of a firm and they rip that firm apart and put people in different departments or areas within the acquirer, and that the acquired firm loses its entire identity. And if it's a different industry, I'm not going to say that that's the wrong strategy in a different industry. The way I view this is we're acquiring a firm that has been successful for decades in many cases. And why would we buy something and then just rip it apart? Like, what's the point of that? It makes no sense to me. I'd rather buy something that's doing well, right? And then what we bring to the table of a bigger company with a broader portfolio, more people, an international brand, right? 1 plus 1 should equal 3 there, not, rip it apart and, hope that the pieces fit into, another part of your business.
Well, what
And
about this then, Joe? We talked about the people and the projects are essentially what make an architecture firm. Um, have you come across opportunities where there are good individual people and there are good projects that the company is able to work on, but because of the internal structure, the resource allocation, the people just aren't working well together? In that situation, perhaps does that like sound like an opportunity where you would take people and like pull them apart and put them into different places? Have you come across opportunities like that, or the business wouldn't even exist if that happened?
yeah, I think they'd be struggling
Yeah.
if a company couldn't get along internally, they're going to be struggling most likely, and um, and then if they can't get along internally, we probably would, even if we were going down the path, we probably wouldn't be able to negotiate a deal because the dynamics on that side would disrupt it. But assume we did, right? And when then
Mhm.
we closed that deal and we brought them in, then we would knowingly be bringing in a dynamic into Michael Graves that could be negatively disruptive, right? And so like in our process, we would have cut that one off
Okay.
real soon, along the way. Yeah.
Got it. So you talked about sourcing. We talked about integration. I want to dive a little bit more into that. So as you are bringing a firm on, actually, let's take a step back. There is the evaluation process. So tell me more about how you get to that decision about whether you want to pursue a company or not. Is it asset class? Is it geography? Is it some other thing that you are looking for?
Yeah. Well, um, I generally can look at the design, like, on their website or whatever, and determine, hey, this is good design, great design, or maybe it's not even good design. If I'm not sure, I'll send it to Robert Blazer, partner, and he'll weigh in, because design question. But I'm not an architect, but I'm a user of buildings, right? And I have, an opinion on what looks good and what doesn't. But I'll defer to my architecture partners on that. But it really does come back to people, right? So if they do good work and it's a good business and they're great people, right? Those are the ingredients. Then you get into two other aspects. Are they where are they geographically?
Mm-hmm.
And then what sectors are they in? So geography, it's just more reach, it's more clients, it's more projects. So, you know, generally the continental US is where we're looking. In terms of market sector, again, mile wide and inch deep. I mean, we've quadrupled in revenue since the first acquisition, but we're still a mile wide and an inch deep, right? If you compare us to the top 10 firms in the industry. So it's not like we say, well, we've done enough acquisitions in this building type, we're done. If it's a good business, it's more like we're not at capacity, anywhere near capacity. And then there's other sectors where we are very thin, like healthcare, for example. Is we only have a few active projects, and we need to build that sector. That's one where we really want to find the right partner, and do that one. So all of those things go into the evaluation. But if you know they check the box on sector, financials, geography, uh, design capability, but culturally we won't get along, kill the deal.
So that's a really great overview of that evaluation process. And you specifically mentioned healthcare. Does healthcare in your context mean hospitals? Does it mean medical office, senior care? Like, what do you include in that bucket?
Um, the senior care, senior living, we're building that. We have a good amount of that. It's more on the hospital side, MOB a little bit, but really the infrastructure projects, hospitals and emergency rooms and things like that.
And uh, in terms of evaluating success once someone has come on, you talked earlier about the typical structure where person and or a leader and his team will come on, and they expect the expectation that they stay on, they keep on producing and take advantage of a lot of the branding strength and the back of house and organizational strength of the firm. When you are sitting down with partners from the firms you have acquired every quarter, every year, what are the things that you are focusing on in terms of the evaluation?
So at a high level, we'll set, excuse me, we set the annual budget, and the budget's going to be, set in a way that marries current reality to the deal we did. We obviously want each year's budget to be such that they hit their targets for their earnouts, right? We want that. We also have a very incentive rich program, the way we structure these deals, where we not only allow, we want the acquired team to be able to simplify this, to eat what they kill. So above the baseline of the deal, if they double, let's just say, in revenue and profit, we let them take upwards of 70-80% of that excess profit and cash flow to incentivize them to keep growing. So the budgets will be built. So we'll take that into account in how we actually, measure success sort of after the fact. And the budgets we're going to build based on reality, as we know it. So it could be that in any one year, the budget is such that they're not going to hit their target. And then we'll push it. And if they're successful, if they're close, obviously we want to pay the earnouts and everything. But we don't want to really set targets that are unrealistic, and we understand that this is a people-based, project-based business. So we got to have a little patience from time to time. Things like right now, interest rates are still very high, and it's really impacting our multifamily and our hospitality sectors. Gonna come around, and then those guys their P&Ls will straighten out, and they'll be in better shape. So you gotta have a level of patience. So we look at it that way, but we also drill down monthly into I don't know, 10 or 12 KPIs that really is insightful, because it's standard across all the business units, but you get to see where, if you throttle this a little bit and you throttle that lever a little bit, profitability can go up. And it's a clear line of sight into the levers that drive profitability in a people-based, project-based business. So we
So
manage.
got it. So that's a very clear structure that you're describing. So
And I'm sorry, Octave, one more thing. At the end of the day, like, we always have the eye on the valuation growth. So the more the more acquisitions we do, the bigger we get, and the better we are all financially. All of those things are going to drive that valuation up. And all of the partners that we've acquired and have microgrids are all going to participate in that as well. So again, like I said, a very rich incentive structure for firms that we acquire a controlling interest in, but let them roll a lot of equity and participate in the growth of this.
and when you say the valuation of the company, it's based on a measure of the profitability as well as the multiple that is applied to the profitability of a firm. So, are there specific things that you've observed that increase the multiple that is applied to your business? Like, for example, adding a technology business or adding engineering services perhaps down the road. What are some of those things that you've explored around increasing the multiple that's applied to the revenue or the profitability of your company?
Right, and obviously the easy one is scale. The bigger the EBITDA, the higher the multiple. But I think the brand is very key for us, and is an add to that valuation, to that multiple. And then just using the term the platform company, which is what we are, what we have. So we have a brand led platform company that and at some point a private equity investor can invest in and just let it keep going, because we know what we're doing in terms of running the business and integrating. And that, go take it back to integration. That's, I think, the one area, and there's a number of things in there that we focus on. They're sort of very tied and parallel. It's important. The things we focus on for integration drive the value of our company in terms of monthly, annual profit. If you do these things, you will be a healthier company.
Mhm.
And also, if you do these things, a private equity investor is going to place more value on that. And let me give you an example. Succession planning. Um, we're in the middle. We've now, we're up to 165 people. It's now, we're formalizing this process into our routine annual performance management review process. So if I'm sitting across from somebody who's looking to invest in us and I don't have an answer for what happens when I'm gone, or if I get hit by a bust, what happens? Who takes over? And then, all the different leaders. Well, when this person retires, who's going to take over that business unit, that studio, or be the leader in hospitality design, et cetera. So we think through that for the, like I said, the parallel purpose. It's important for us because you need to do that stuff to run a business effectively. And the ultimate goal of having the private equity investor, if we didn't do that, right, they're going to say, well, you may be worth this, but now we have to come in and do all these things that you didn't do, so we're going to discount you. So I try to look at it through their lens, in everything we do, and there's not really a conflict there. Like, well, this is good for the private equity side, but it's really not healthy for our business. We avoid those. I don't know that there are. I guess harvesting the business, right, to drive profitability might drive a higher valuation, but it's very short term in nature. It's not good and healthy for our business. So we really try to keep them, keep ourselves focused on all of those things.
Great. So you are looking to build a growing um, architectural design, technology, other related services business in the midst of really significant economic turmoil and really significant technology transformation. So talk to me about things like demand volatility around office, interest rate volatility, and how that impacts the two sectors that you mentioned earlier, and the rapid integration of AI into workflows that will change what your people are actually doing as you're bringing on more people from other companies. So given that the background that is the one that you're working with now, how would you define the vision of your firm going forward?
All right, so the economic impact. It's really those two sectors for us, uh, multifamily and hospitality, and that really makes up for the most part three studios. There's crossover in others, but um, the three that are focused on multifamily or hospitality are impacted.
Mm-hmm.
They have countless projects that are through concept, entitled, approved, uh, where our clients, the developers, are just waiting for the interest rates to come down, and then they'll pull the trigger. So I think when that happens, and that was me knocking on wood, I'd like to see. I'm real hopeful and optimistic that a number of these projects are going to turn loose, and we'll be in hiring mode if that happens. So other than that, like, things are, pretty good, overall. I mean, and I think that it's going to be great once we see now, is the reduction 50 basis points? Does that move it? Is it a full point? That I don't know. I think just the long term, like if it's more than that in the long term, that might be enough to get things going. So, that's my point of view on the impact from the economy, on us. On the technology side, I'm old, right? I know what I don't know, and I try to really trust the younger people. And Aaron is much younger than I am, and from a Parallax and a Revit standpoint, like he's a rock star in that space. And there's just been so much, and like Austin Crowley, another younger, very talented designer that we have. I mean, he's one of the guys who came to me several years ago and said, "Hey, we need to invest in this, this, and this." I'm like, "Well, what's that going to do for us from a return on investment?" And, he was like, what do you mean? He got it, but like, he couldn't really
Yeah.
tell me like, we spend $1, we're going to get $10 back. And like, I know that, like, it's like marketed too. Like you got to trust if you spend money, you're going to get a broader reach and good things are going to happen, but it's hard to really pinpoint exactly, the return on that dollar. And, the same with the technology, but I knew enough to know what I don't know and trust these younger people to run with a few of these different softwares. Like, so the Revit's the big one, and then there's
Hmm.
Enscape, and several other platforms. I'll forget the names to them and mess it up. You don't want to hear it from me anyway. Um, but
Maybe a
you know,
future episode with one of
with
the talented younger
almost
folks.
modern, yeah, yeah. Let those guys talk this stuff because they're real good at it. Um, but that the world is changing. We know this. AI is disruptive and it's impacting virtually every business. Um, there's components of it in what we do with Revit with Parallax, and there's things in on the design side. Like I could tell you on the administrative side, we have a consultant we brought in, a friend of mine, and so our finance, accounting, marketing teams are using AI more and more for different
Mhm.
tasks. And then on the design side, uh, Robert Blazer and Austin and others, they're using it for, it's like, I guess the way I would say this being a non-architect, it's a way to generate an idea quicker and then take that idea and then do your thing with Revit and, all the other software we do. Architects still need to be architects. I don't think that like, yeah, AI is going to replace Robert Blazer, right? Or it's just not going to happen. What it's going to do is going to make us more efficient.
Mhm.
Will jobs be? Will there be less of jobs? Certain types of jobs with all this technology change? Absolutely, but other things, other jobs are going to be created. I take this back to an accounting standpoint, right? There was a time not that long ago that accountants used manual sets of books, right? And
Mhm.
then then the computer came, and
There's that
there's
expression, balance the books, literally
yeah,
means
close the
books.
books. Yeah, it closed the books, right? And but there's still need accountants. It's just you do the job differently, and probably there are fewer people doing that, but that's just the evolution of business. But I think it's scary for people because a lot of and more than I think in the past with the more powerful computers and the software. I think now you hear more like, well, AI is just going to take your job away,
Mhm.
and maybe at some point in the future, but I don't think it's like we're not going away. You're design. You're a developer, Atif, right? So
Mhm.
who's gonna sign for the professional liability insurance? Well, if AI is just you push a button and here's your drawings and your building, right? Where's your comfort in that as a developer?
So I think from that question, what you're talking about is a skill set around being an architect, or in the example that you've given about being a developer, is both about the vocation, like the doing of the thing, the drawing of the building, or the preparation of a pro forma that allows a particular project to make sense. And then there is the taking of the responsibility of that. And I think that whether that's a personal guarantee on a loan in the case of a developer, or that is stamping a set of drawings with your livelihood on the line, courtesy of an insurance company helping out, those second set of things, I don't think there's a clear answer of what that means with AI. So I would imagine, I'm interested in your perspective because you're in the thick of it, is that a really successful architect understands the pieces of the vocation that should be given over or can be given over to something else, but really hone in on where does that responsibility aspect um, come in terms of leadership, like, yes, leadership, and also things like guarantees and licenses.
Yeah, yeah. And I mean, just go back from drawing everything by hand to using AutoCAD to using
Mhm.
Revit, right? It's an evolution, but there's still architects through that whole
Yes.
process, right? And I guess in the the 80s when people started using the computer to draw and less by hand, perhaps there were conversations like, oh, you know, our jobs are going to go away. I would imagine that happened, and it's happening now, those conversations, but it's just going to make for more efficiency, and then maybe there's less of a certain type of job, and that, opens up opportunities for people in other areas. So I'm not worried about it. I just know we need to embrace it. I don't have all the answers, but what I will tell you is if you don't embrace the technology changes in business, that's a recipe for disaster.
If you, in that very heartwarming message, I want to focus in on the ask. So you guys are a growing business, and we talked a lot about acquisitions as a key component of your growth strategy. So what kinds of businesses should reach out to you, and why should they reach out to you about potential discussions around acquisitions?
Yeah, well, so architecture firms and engineering firms. So there's 80,000 AE firms out there, and 90+% of them are 30 people or less. So generally, that means that they don't have the professionalized infrastructure. So, and many of them don't really know what they're going to do. They're entrepreneurs, they're business owners. What's going to happen with their life's work when they want to retire? And an internal transition is one, but generally speaking, those internal transitions don't work out because the people looking to buy from the owner don't have enough money to pay the owner what the owner wants for the business, and frankly, probably deserves. Yep. Understanding what your value of your company is, understanding the things that you need to do to drive the value up, professionalizing the business. That's a whole series of different things. And so if you're in that world and you're asking yourself those questions, then, reach out, because, you may be, if you're interested and we're interested, there's an opportunity to become part of Michael Graves as an architecture interior design firm. Or if not, there's an opportunity for me to help you figure out what your path is. I've had, unfortunately, these are really it's not a fun conversation when I'm talking to a business owner who's in their 70s. They don't have a successor. They don't have anything of a succession plan. They want to retire in 6 months and sell the company. And it's just sad that, they worked for 50 years and that's the end result of this business. And I hate seeing it. And, in architecture, we joke about it a lot. They're talented people. They're brilliant people. Architects are brilliant people, but many of them, I won't say most or all, I'll just even say many of them, are not really focused on the business of architecture. And that really is a disservice to the industry. And that's where we can help. I can help somebody focus on that. And by bringing firms into Michael Graves, we can really move the value and give you a plan, a legacy, a spot for your people. And the valuation and the financial reward for your life's work at a level far greater than you could just selling it, outright and going away and disappearing. It's a different deal. And certainly running it into the ground. That's unfortunately part of an exit strategy. It's one option in an exit strategy. And I think it's just horrible to think that way.
What is the best way for people to get in touch with you, Joe?
My email is on the website, jfurey@michaelgraves.com. In my, when you go to team, and email is the easiest way.
Perfect. So that email is a perfect way. And then for anyone that wants to reach out to the podcast, you can do so via LinkedIn. We'll send those messages over to Joe as well. So I appreciate your time today. This has been a fascinating special episode to understand the behind the scenes nuts and bolts of how a firm transitions, how a firm grows, and how a firm looks forward. So thank you for your time.
Thank you, Atif. Good seeing you.
I'm Atif Kader, and thanks for joining me on American Building. If you enjoyed this episode, be sure to subscribe on your favorite listening app and leave a rating and review. America's housing crisis is one of our greatest challenges, but what are the real solutions? Hear from the developers and other industry experts driving meaningful change. Get our exclusive guide, Housing in America: 8 Ways We Can Solve Our Way Out of a Crisis, at AmericanBuildingPodcast.com.